for today. And for those of us who are joining for the recording, why are Michigan's energy prices so high? An introduction to cost drivers, emerging issues, and how utilities are regulated in Michigan. For our attendees, our live attendees, please note that you can share thoughts and questions with the panelists or all attendees through either the Q&A function, which you should find in the middle of the bottom of your screen, or the chat function, which you should find on the right of your screen. Sorry, the right of your screen. We should have plenty of time at the end of the presentation today for questions and answers. With that, I'd like to start by introducing our first speaker of today, Erik Nordman, Associate Professor and Director of the Institute of Public Utilities at Michigan State University. Erik, thank you so much for joining us today.
It's my pleasure, Dan. Thank you so much for the invitation, and thank you for hosting this topic. It's such an important topic. People are talking all about energy affordability here in Michigan, but also nationwide. So yeah, we'll go ahead. Oh, as Dan mentioned, I'm the director of the Institute of Public Utilities at Michigan State University, and we provide continuing education programs for the regulators of the utility sectors across the country. So that includes the folks that regulate the electric, water, natural gas, and telecom sectors at public service commissions and at the federal level too. All right, so that's my pitch. Now let me pull up my, I gotta share that, share slideshow. Okay. All right, so why are Michigan's energy prices so high? So over the next 20 minutes or so, we're going to talk about how utility rates are regulated in Michigan, and we'll talk about and identify the cost drivers nationally and here in Michigan. So our utilities, including our electric utility, are generally considered natural monopolies. That is, one firm can satisfy the demand at the lowest cost, right? We don't need, there really isn't going to be much competition. These are natural monopolies, have characteristics of industries that rely on networks. So that's why electricity, water, natural gas, and telecommunications often fall into this class of industries called natural monopolies. They have a number of characteristics, such as high barriers to entry. It's very difficult for a new firm to come into this sector. There are high fixed and capital costs. That's actually one of the high barriers to entry. It also means that investments in these things tend to be lumpy. Building a centralized electricity generation plant, building a wastewater treatment facility, things like that. These don't really lend themselves to having, multiple competing options, right? So although that is changing, especially in the electricity sector, as we have distributed energy resources, but it still tends to be a high capital cost industry. But along with that, there are low marginal costs. Once you've built that facility, whether it's a drinking water treatment plant or electricity generation, the cost of delivering another gallon of clean water, another kilowatt hour of electricity, it's relatively low. So these have low marginal costs. And there's also a tendency for one company to integrate production, transmission, and distribution, and we call that a vertically integrated utility. Here in Michigan, our investor-owned utilities, DTE and Consumers Energy, they do not do transmission. They do electricity production and the distribution functions, but they do not do the transmission function. All right, so because of all these traits, there's a tendency for firms to fall into this natural monopoly status, and that's really the best way to deliver those services. At least that was, through much of the 20th century, given the technology, that was really what we fell into. But in exchange for having that monopoly status, the utilities agree to be regulated, right? That's part of this regulatory compact. So the market isn't going to set competitive rates, right? There's no incentive for the utilities, since they have this natural monopoly, to economize on their costs, to drive costs down, to deliver better services. So it's really up to the regulators to set these electricity rates and make them competitive, right? This is a picture of Alfred Kahn, a famous economist who wrote The Economics of Regulation. He said the central continuing responsibility of legislatures and regulatory commissions is finding the best possible mix of inevitably imperfect regulation and inevitably imperfect competition. So that's really the role. How do we, there's not a one-size-fits-all approach to this. Some states are more market-driven and there is a role for competition. In other states, they prefer a more regulated environment. But there also is a role for competition in limited states, limited sectors, even in Michigan, which is a relatively heavily regulated state. The challenge is finding the just and reasonable rate for a utility, right? In the absence of a market, what is that going to be? So that's where economic regulation comes in. Economic regulation guides the structure of an industry and the behavior of firms. It's the specific subset of regulation more generally. Economic regulation, they may affect the structure of an industry by restricting the number of firms that can operate, right? So in this case of electricity, we have monopoly territories for our investor-owned utilities. They also guide the behavior. There are controls on pricing, investment, service quality, and coverage. So this is the history of economic regulation goes back to the 1880s. Economic regulation entails a wide range of governance arrangements, from outright state ownership to establishing rules that promote competition and markets. Scott Hempling is a legal professor who wrote Regulating Public Utility Performance, and he says the common purpose of all regulation is performance. In the absence of regulation, the private behavior of the utility firms may diverge from the public interest. Effective regulation, on the other hand, aims to align private behavior with the public interest, right? So regulation defines standards for performance, then assigns consequences that may either be positive for, meeting those standards or exceeding those standards, or negative consequences for failing to do so. And that way aligns the public interest and the private behavior. We want them converging rather than diverging, right? So the common purpose of all regulation, including the economic regulation of our utilities, is to align the public interest with the private behavior of those firms. So the regulators of our electric utilities, along with natural gas, water, not water in Michigan, but in some states, and telecom, are these public utility commissions or public service commissions. They go by several different names, but this usually happens at the state level. We're focused on intrastate utility operations, not interstate transmission at this point. Many of these commissions were established in the early 20th century, and in many cases, they covered lots of different industries than they do today. But typically, most states have a commission that regulates electricity and natural gas. Telecommunications was once very important, but that significance is waning as the technology has changed, and also some of the regulations at the federal level changed. But these public utility commissions or public service commissions are usually considered independent, but their regulatory powers and their jurisdiction are established by either state constitution or by legislative statute. The statute may order the Public Service Commission to take a specific action, or it can authorize it, and then the Service Commission can decide whether or not it wants to act. Some states elect their commissioners, while in other states, the commissioners are appointed by the governor. This has been very contentious lately. Some states that elect their commissioners are actually trying to change it to appoint them. And then at the same time, other states who are appointing theirs currently want to switch to an elected system. There doesn't seem to be any benefit to one system or the other. Here in Michigan, our commissioners are appointed by the governor. But there doesn't seem to be any difference in the outcomes when it comes to energy affordability or reliability or anything like that, whether they're elected or appointed. These public service commissions are sometimes described as quasi-judicial tribunals. Public service commissions act as courts of jurisdiction over the utility rates, the terms by which those utilities are bound, and the conditions of service. The proceedings have a strong focus on transparency, accountability, public participation, and due process. The commissioners act as judges. So they adjudicate cases using rules of judicial behavior, procedure. They're charged with ensuring reliable and affordable access to utility services, and they're specifically active in utility planning, siting, cost allocation, and cost recovery, as well as other duties. All right, so utility rates are considered fair and equitable when each customer class pays the costs allocated to that class. All right, so when the regulators are looking at the utilities and trying to figure out, well, what is the just and reasonable rate, they follow three basic steps. First, we need to know how much does it cost? How much does it cost to deliver the service, whether that's a kilowatt hour of electricity or a gallon of clean drinking water? You need to know how much does it cost overall, and how much does it cost to serve each of those classes, the customer, the residential class of customers, commercial, and industrial. The total amount that it costs is called the revenue requirement. This includes the operating and capital costs. So that's the overall cost of delivering that service in a year. The second step is to determine who's going to pay. This is how we allocate costs according to those customer classes, the residential, commercial, and industrial classes. In some cases, like residential classes, we have lots of distribution lines, so that tends to cost more than serving one large industrial customer whose factory is right, very close to a transmission facility where it's relatively easy to hook up, right? So we have to allocate those costs determined in the revenue requirement to each of these classes. And then the third step is figuring out how each of these customer classes will pay. And that's a matter of designing the rates. That includes the level and the structure, what fees will be fixed customer charges, a flat rate, just for having a meter versus what's a variable cost, a cost per kilowatt hour, time of day rates, peak hours, demand charges for industrial customers, and things like that. The rate base is the key element in utility rate making. It's the basis on which utilities earn their profits. And because of this importance, it's been the subject of controversy for the better part of a century. FERC, the Federal Energy Regulatory Commission, defines the rate base as the value of a property upon which a utility is permitted to earn a specific rate of return as established by a regulatory authority, right? So this is how the utility makes its money. This goes back, this has been adjudicated at the Supreme Court level for over 100 years, but it goes back to this obligation to serve. that in exchange for having a natural monopoly, you get, exclusive right to serve these customers in a territory. The utility can't pick and choose who they want to serve in that territory. They have to serve everybody, right? This is called the obligation to serve. The investor-owned utilities carry out this obligation to serve by using their investors' money, their shareholder investment. But this shareholder investment is private property. So using private property to carry out a government mandate is a Fifth Amendment taking. So that's the second piece. So if the regulator is going to require the utility to serve and use that private shareholder money to carry out that obligation, then those shareholders must be compensated. Right? So it's a compensation for this Fifth Amendment takings. So they're allowed and entitled to the opportunity to get a reasonable return on the fair value of the utility property invested. So this is where it all comes. This is really the key part of rate making, where the investor-owned utility shareholders are entitled to the opportunity to earn a return on the invested capital. Now, all of this means that fair and equitable does not necessarily mean affordable. When we talk about fair and equitable rates, we're talking about fair to both the customers and to the utility shareholders. The utility shareholders have the opportunity to earn a return on their investment. And the rates have to be equitable in that the customer classes pay for the costs incurred to serve them, that we avoid having cross-class subsidies. When we talk about affordability, when rates are unaffordable, that means it's the inability of the poorest segment of this customer base to fund their proportionate share of the total costs of the provision of the services. So rates can be fair and equitable in that the costs are allocated appropriately, and yet they could still be unaffordable if people can't afford those fair and equitable rates. So let's take we got about 3 minutes, and I'll go through some of the cost drivers nationally and here in Michigan. The Lawrence Berkeley National Laboratory has been tracking electricity price trends. Over the last 6 years, from 2019 to 2025, we can see that electricity rates have been going up nationwide and on average, but within that average, there's a lot of diversity. This graph or map shows nominal, so it's nominal electricity rates changes. So this is not correcting for the effects of inflation. This is the price that's on your bill. You can see that the Northeast and California prices have gone up a lot, up to 12 cents per kilowatt hour or more in the state of California. In Michigan, we're kind of in the middle in that 4 to 6 cents range. Over the last year, so from 2024 to 2025, many states also continue to see rising electricity prices. And this graph documents what the primary drivers are for those price changes. You can see up at the top, it's fuel and wholesale supply. That's the biggest driver of the electricity price increases nationwide. Second is the distribution cost. So that's the cost of delivering that last mile of electricity to your house, to your business. And then you can see generation, capital expenditures. That's new capital investments on the generation side, on transformers and other equipment. You can see way down towards the bottom, you see clean energy policy. States with RPSs, renewable portfolio standards, do show a slight increase in electricity rates compared to those without our renewable portfolio standards. But that's way down towards the bottom. You also see storm recovery costs in there, et cetera. Here in Michigan, the recent rate increases are driven by reliability investments. Michigan ranks consistently near the bottom in terms of utility reliability. So in 2024, the Michigan Public Service Commission commissioned a third-party audit of DTE and Consumers Energy and say, what are the causes of our really lackluster reliability? And the audit showed that it's a number of things. Sorry about that. Oh no, I didn't put it on it's for DTE, it's old circuit breakers. They have many of their circuit breakers are from 1930s to 1960s. So these are old, aging, and need to be replaced. And they have overgrown brush and trees. So vegetation maintenance is a big driver of this. And when they get a backlog, those branches, in a storm, fall on a distribution line, knock out power. For Consumers Energy, that audit found that those Consumers Energy merged with several smaller utilities over the years. So there's a large number of low voltage distribution lines of various voltages. So there's kind of a mess in there. Also, they have a lot of small diameter distribution poles, which are susceptible to breaking. And vegetation management, again, was highlighted as a problem. There's a backlog of tree trimming and things like that. So the recent requests for rates are driven by this reliability investment, and it's focused on the distribution system. In 2025, Consumers Energy requested a $436 million increase driven by these reliability investments. The Public Service Commission approved $276 million. Immediately, they came back and requested another $456 million. So this really gets to this tension between affordability and reliability. And in conversations that I've been having, I noticed some language that people were using that in some cases, that we need to balance affordability with reliability, that these are in tension with one another. If we're making investments in reliability upgrades to our distribution system, is that going to raise rates? Well, that's what the utilities are proposing. And this is in tension with that question of affordability. But what if we change the paradigm, change the thinking, and align affordability with reliability? That these are not in tension with one another, but are there technologies and practices that can both reach our affordability goals and improve reliability? I would argue that there are opportunities for that. How can we do this? Well, there's a phrase, use more before you build more. The utilities earn their income, right, by building infrastructure and then earning a rate of return on that. So that's going to be their default. But we really need to get more electricity services out of our existing infrastructure. So that's one thing. Innovation. We need technical innovation, but we also need institutional innovation. And I think a great example of that is the Sustainable Energy Utility in Ann Arbor. They have a parallel municipal institution that's focused on clean energy services, but that's operating in parallel and complementing the existing investor-owned utility, DTE. And there's conversations around regulatory lag. This is the period of time between rate increases. The longer the lag, the greater the utility has to live with its decisions that it made, and it serves as a belt tightening function. If it didn't, if costs are going up, instead of just coming back and asking for more money, they have to live and economize and, cut down on their costs, keep those rates steady for a longer period of time. Here in Michigan, we have a 12-month minimum. So literally on June 2nd, 2025, Consumers Energy increased its rates. And then on June 2nd, 2026, they came back to the Public Service Commission 12 months a day later, asking for another $400 and something million. So if they had to live with that, I mean, there's not even time to adjust for the experience of living with those rates. So there's talk of possibly expanding regulatory lag, that time between rate cases, but that's up to the legislature, and we'll see. So that I will end there, and I think we'll turn it over to Mike for his thoughts on the topic.
Thank you so much, Eric. And I look forward to continue this conversation in the next half hour. Now I'd like to introduce Mike Troupos, Vice President of Foresight.
Thanks, Dan. Okay, so Eric just did a great job giving you the surgical view on what's going on in Michigan and what are the major drivers from a utility standpoint. I'm going to take a step up and look more big picture at energy and what's going on with energy and some of the other major drivers. But I think Eric's foundation will be really helpful for the second half of this conversation. So let's jump in. When I do this slide live, it's always fun to watch A, the audience squirm, and then B, to ask people to raise their hands on whose fault they think it is that our electricity rates are so high. And if you were paying attention during Eric's presentation, you may have a little bit of a head start on this question. However, what I love about this slide is almost everyone, I would be shocked if anyone doesn't know who the first two people on the left-hand side are, but almost no one can tell me when I do this live who the two people are on the right-hand side. And so then you often get people skewed towards either it's Trump's fault or it's Whitmer's fault that my electricity rates are so high, and they don't really know who the two people on the right are. So I'm going to actually take you through all four. I would argue it's actually all four of their faults. It's not necessarily evenly distributed across all of them. I think a lot of people, just based on the news cycle, and maybe I should just state this ahead of time, I am politically orphaned and don't really hold any really strong political inclinations towards Republican or Democrat. So I'm sorry if I'm making you squirm on some of this stuff. But basically, I think a lot of people in the news right now would like to think that the president is the supreme leader. And the reality is we live in a market economy. And so I would say Trump is actually not all that responsible for electricity prices being high. And that's not because of anything he's doing. I think a lot of his policies are actually destructive and are resulting in higher energy prices, specifically bailouts and subsidies of coal, which is not economic. However, the president actually doesn't really control a lot of energy. The energy market is massive, and a lot of presidents haven't really been able to do anything major involving specifically electricity rates. And the reason why is because they're governed at the state level. And so that's where we come to Whitmer, where I would argue, again, she holds a decent amount of responsibility as well. Like Eric mentioned, we have some pretty aggressive renewable portfolio standards, which I would argue are good just for the air quality and water quality in our state, but do ultimately, to some extent, drive up rates. I would argue it's probably worth it for the public health benefits. But again, some of her policies have resulted in higher energy prices. What you might be wondering is who are these two people on the right and how are they impacting it? So the guy to the right-hand side, his name is Dan Scripps, and he's the chair of the Michigan Public Service Commission. So Eric just mentioned that's the board that oversees utility companies. So I would actually argue out of the 50 or so public service commissions across all the different states, Michigan, our team of three is probably a top 5 or top 10. They're really good. But still, like Eric said, they're approving hundreds of millions of dollars. Certainly, they're disallowing hundreds of millions of dollars as well. But that's their job, is to basically regulate the utilities. And so a big piece of what's happening is the Public Service Commission. Again, I think they're doing admirably, but that's a big driver. And then the last person is the new CEO of DTE, Joy Harris. And I don't put her up just to pick on her. I could have put the CEO of Consumers Energy or Indiana Michigan Power or anybody. But ultimately, I would argue a lot of it is driven, and Erik kind of covered this in his last slides. A lot of it is driven by the utility companies. Because it's a publicly traded company, Joy's salary is about $1 million. Sweet. I would love to have a salary of $1 million. However, if she hits all the metrics that the board has put in front of her, her total compensation actually is closer to $10 million. And so, and she's a very intelligent person. Every CEO of a utility company is intelligent. They're going to want to get that $10 million. And so in many cases, that results in not driving affordability, but driving, like Erik mentioned, things like making massive investments when they may not be necessary, et cetera. And so all this to say, there's a meat grinder here of politicians, regulators, and utilities, and I think we can do better. I'm going to finish with some of that, but yeah, the Charlie Munger quote of "Show me your incentives, and I'll tell you the outcome" really rings true on the fact that we've just set up kind of bad incentives for utility companies, and so this is kind of what we end up getting right now. Okay, so that's always like the thing I get asked about a lot the last 2 years is why is energy so expensive, and everybody has their theories. So I figured I'd demystify that and maybe get your attention here. Let's jump into like what's changing, right? I think that's something that a lot of people haven't really like sat down and thought about. And I would argue, I've said this a lot. I've been in the industry for about 15 years. I've seen more change in the last 2 years than I saw in the first 13 years combined. And that's not a coincidence. So what basically happened, and Erik mentioned this, the electric grid really started in the late 1800s with Thomas Edison. And for basically 100 years, America needed to electrify. Every year, the grid got larger. It reached farther. It's electrified more people and more companies. And so you had basically 100 years of growth. And the regulatory model that I am complaining about in the last slide was built over that time, and it worked because we needed to build more things and we needed to expand the grid. And then what happened is right around 1990, per capita electricity consumption in America started to flatline. So basically, from effectively 1990, you could say to 2010, but you could almost push that to COVID, 2020, per capita electricity consumption in America was flat. And utilities had really no meaningful or material revenue growth because efficiency, right? If you think about it, that was the era of people went from incandescent and metal halide lighting to fluorescent, which was much more efficient, and then into LEDs. And refrigerators from 1990 to now have gotten probably double the size and now consume still half as much as those half as large ones did 30, 40 years ago. So we've seen wild technology improvements, and that is why we have seen per capita energy consumption flat. However, things have changed dramatically, and I'm going to get into that over the next few slides, where we have a significant growth in per capita electricity consumption driven by a handful of factors, the biggest of which is AI. In AI data centers, we're just seeing a significant amount of new appetite for building more data centers, and specifically AI ones by the Magnificent Seven or the hyperscalers is the terms. These are your Metas, Amazons, and Microsofts of the world who are saying we are selling tons of compute and we need more power and we need to build more data centers. However, it would be lazy to just blame it on that. That's not the actual only driver. And I'll talk about this a little bit in the next slide too. The reality is electrifying your economy is good for your economy. And so what we're seeing is electric vehicles, albeit maybe slower than a lot of us anticipated, continue to gain market share every single year. And so what happened is, and a lot of people don't talk about this, total, not per capita, total gasoline consumption in America peaked in 2019, and I would argue it will never return to that peak. We are running more of our economy on electricity, so electric vehicles are driving that. Even my lawnmower is now electric. It performs better, it's quieter, and I like it a lot more than a gas-powered lawnmower. So you're seeing this not just in vehicles. Obviously, they're the biggest, but there's a lot of different things that used to be traditionally run on other fuels that are running on electricity. And so you're seeing a huge amount of growth. At the same time, one thing Erik touched on that I haven't talked about yet is not only is per capita electricity consumption growing again, we have massively underinvested in our grid over the last 30 years because there was no growth. And so utility companies said, we're prioritizing shareholder returns over making massive investments. And California really has seen that the worst of anybody, where they didn't trim their trees and they had a bunch of wildfires. But man, that dividend was coming out every single quarter for decades and decades and decades. And so we have this bad confluence where we need more infrastructure, but the problem is a lot of the infrastructure that we have is aged, and this is driving a lot of our energy costs up. So you might be like, well, Mike, is electrification really a good idea? This has lately been my favorite slide. I would encourage you, I have my sources for the rest of these slides at the bottom. I would encourage you to go visit this because I cannot find a better slide than this that has the names of the countries, but these are bubbles. And on the left-hand side, you can see share of electricity. What that means is the share of electricity is a percentage of total energy consumed by a country. And you can see the best countries are 35% or higher, and you might be surprised at what these countries are. They're Nordic countries, so think like Sweden and Finland. They're also Asian countries with advanced economies like Japan and China. So, and when I think about those four countries, they're very different, but some similarities are they're all in different areas at the vanguard of technology and at the vanguard of manufacturing specific things. America, we're in the middle. We're about that 25%, but I would argue we are electrifying quickly as well. And so again, I think you'd find a lot of people talk about America has an abundance of fossil fuels, and I don't disagree with that. But the reality actually is, from a usefulness standpoint, and this is something I think not enough people are talking about, I would argue electricity is the most useful final energy source. And the reason why is because all you need to do then is plug a light in, plug in a motor, et cetera, and you can get a lot of work, power, et cetera, done. And so most of America's industries run on electricity. I would argue, certainly, I don't want to discount the fact that liquid hydrocarbons, specifically oil, would be the second best, in my opinion, source of energy, of finished energy. And the reason why is, think about it, like that's why airplanes run on that. You cannot beat the density of things like kerosene, gasoline, diesel, et cetera. And that's why a lot of our mobility runs on that, because the energy density is wild. The upside to electricity is it's very easy to use. The downside is it's hard to store. The upside to like the liquid fuels is it's really easy to store and it's really energy dense. The downside is you have a lot of bad emissions, and you also need a lot of capital infrastructure, specifically motors and engines, to make it useful. And so over time, I think the economy of all countries is going to move towards electrification and high density fuels, and things like coal and natural gas. I get why economies use them. They use them because they're cheap, but the reason why they're cheap is they're actually not that valuable. And so I would just encourage you all, as you're thinking about this, there's a huge trend happening. I think over the next 20 to 30 years, America is going to move from 25, potentially all the way up to the 35, as we move from being a petro state to an electric state. And that will be a huge boon to our economy as well. If you look at China, it's not a coincidence that their economy grew in mind-bending ways the last 30 years, and they also have one of the highest share of electricity usage. So again, something I don't think people talk about, but I think is really important to understand. And then electricity, like I mentioned, the projections for data centers are really stifling here. So this is just specific to AI data centers, but we are looking at a reality where total data center consumption from 2000 to 2020 was really not all that much growth. And basically from 2020 to 2030, conservatively, you could see a doubling. And in wild projections, you could see a 3 and 4x. So in a 6x. So we don't know exactly. I don't know where this is going to go. I just know that the amount of electricity that AI is looking for is insatiable. And we truly cannot build enough generation. It will be, and we need it all. We need, and that's actually where I want to transition to is, yes, the problem statement is clear, but I think a lot of people also don't really understand, like, how is energy made in America? So interestingly, about 40%, so by far our largest source, is natural gas. The reason why is back to what I said before. Gas is just cheap. It's really not that useful for other things because of its volume. It costs a lot to liquefy it and export it. We do that. However, it's also a lot more cost effective to just use it where you don't have to liquefy it, which is domestically. So gas is growing significantly. Again, coal is a fascinating thing. I cannot believe how much headspace it owns in the American conversation for how irrelevant it is. In fact, just in the last few months, solar energy produced more kilowatt hours in the month of, I want to say, April of 2026 than coal did. And it's wild if you look at the graph at the growth of solar in America and just across the globe. In fact, we are actually one of the slower countries from a solar adoption standpoint. However, a lot of people don't realize, yes, call it 50 plus percent of our grid in America is fossil, but actually about 40% of it is low carbon when you look at renewables and nuclear. So certainly we have a long way to go, but we've actually made a lot more progress than people realize. And a lot of that is driven by the fact that we don't want to turn any more nuclear power plants off. They're just far too valuable as a low carbon source of energy. I think small modular reactors are coming. And then wind and solar have just continued to grow significantly, and they have a massive advantage. They have no fuel costs. You have to buy coal to burn it. You have to buy natural gas to burn it. That's an extra cost that utilities and end users have to incur, where if you put solar panels and wind turbines up, your fuel is free. And that is why the levelized cost of energy is winning. And so this is actually an interesting graph that a lot of people don't realize. Coal has dropped precipitously. At one point, it was like 50% of our energy generation back in the early 2000s. And now, again, it's about 15%. If you look at the right-hand side, it's been fascinating for renewables. Hydro has been pretty flat. You see the green, which is wind basically went exponential from 2000 to 2020. It's finally hit the curve where it's actually starting to slow. Solar is still on the parabolic growth curve. Every year, when you look and hear some of the respected analysts, every year they think the curve will bend. This is the year we cannot keep growing exponentially on solar, they say. And then every year it keeps growing exponentially. And the reason why is think about all the underutilized roofs. Think about all the underutilized space we have in the world. And again, the fact that the big advantage of solar is the time when it is the most productive is generally also the time when we need the most air conditioning and the most refrigeration, and the economy is actively working during first shift. And so I think a huge benefit of solar is not only do you have no fuel costs, you also have a wildly productive asset during a time when the grid is the most thirsty for electricity. And so I would argue we're in the first few years of a multi-decade boon of solar. And I could talk about this for hours, but we only have a few more moments. So again, anytime anybody wants to chat solar with me, I'd happily discuss it. And again, this is just another demonstration of what I've just been saying, which is those two blue lines at the bottom are storage and solar. They have basically dropped by 75% in the last decade or so, where if you look at oil, the price of oil has dropped by 25% maybe. And unfortunately, utilities haven't dropped at all. They're basically where they were. And again, a lot of that is some of the things that Erik and I have discussed around getting that finished product and the profits that are needed. But again, these technologies are coming, they're here, and they're becoming more and more disruptive. I do want to finish on a high note. Erik mentioned this, and I think this is really the future of affordability in our country, and that is virtual power plants. I would argue they're better than real power plants. And the reason why is because we can't get enough gas turbines. If you order a gas turbine today, you'll get it in 2031. And we don't, solar is great, but at some point you also need storage so that you can help make sure that you have power in nights and weekends too. So what we're seeing is the future of utilities is virtual power plants. And what that means is effectively you consolidate a bunch of batteries or a bunch of smart thermostats or whatever. And what happens is when the grid is really struggling on a really hot day in July when it's 100 degrees, and you roll up, I'll make it up, 10,000 thermostats in the state of Michigan or 10,000 electric vehicles, and you say, hey, for these 4 hours where the grid just cannot generate any more power, we're going to either start to discharge these batteries from your electric vehicle into the grid and we'll pay you money, or we're going to pay you money and have your thermostat go from 72 degrees to 75 or 76 degrees. And what you're seeing here is the cost savings for the benefit is wild. To build a new gas turbine, you can see here is about $70 million. Sorry, the $43 million. To get the same benefit with batteries, you only need to spend $29 million. And to get the same benefit with a VPP, you need to spend $2 million. So basically, it's 95% reduction in cost to get the same benefit to the grid using a VPP as opposed to building a new gas plant. And the reality is this, the utilities fought this big time because of, like Erik said, the only way they make money is by building things. So they didn't like this. But at some point, if they want load growth, if they want to attract the next generation of data centers, they have finally cried uncle and realized we're putting as much solar up as we can. We're building as gas plants as fast as we can. It's still not enough. And so they've finally opened the door to VPPs and stopped fighting it in a lot of states, and the results are incredible. And they're realizing basically this is their only hope to really start to meet the moment. And so I believe over the next 20 and 30 years, once you open this can of worms, regulators will not allow the utilities to go back to their lazy build more approach once they see the benefits of VPPs. And so I think this is the future of where we're going, which is we have this giant grid and we actually just need to run it a lot better. And this is the future of that. Okay, that's what I wanted to talk about. If you're ever interested in talking about energy or sustainability or environmental health and safety, I would love to have a conversation with you. Our company helps industrial manufacturing, but just businesses in general, make progress on their energy, sustainability, and EHS journey. So would love to connect with you, and thanks for the opportunity to present here. Here's my contact information.
Thank you so much, Mike and Erik. We're going to have both their contact information in the materials that we send out shortly after our webinar today for follow-up information. And we do have around 10 minutes for questions today. And I'd like to start us off with one of my own. I see there's about a half dozen in the queue already. Something I've been fascinated by, and Mike, you're uniquely positioned to talk about this, is through your seat on the Utility Consumer Participation Board. And Erik, I know you're very familiar with this as well, is the small industry professionals that exist specifically to engage with the Michigan Public Service Commission. And I don't know if we might share a few thoughts about how that process works to be an intervener and to bring a case before the commission, and who has access to do that.
Yeah, so the intervention process has two major components. There's the legal side of it. So certainly if you want to intervene, you're going to need some lawyer that is very familiar with the intervention regulatory process at whatever state's public service commission that you want to intervene in. So there's a component of that. Having someone that does that is a big piece. And then the second half of that is then you also need technical experts that have deep expertise in rate making. Again, Erik teaches classes on this kind of stuff, but there are people with PhDs in rate making, in utility modeling, et cetera. And so generally, Dan, when you see organizations, typically it's nonprofits, intervene, they have either a combination of in-house and subcontracted, both legal and then technical experts. And those technical experts will make the argument that, hey, specifically, you're being too harsh on solar, or your model is incorrect in that you're overvaluing certain assets and undervaluing others. And so we remodeled it, and this is our recommendation. And then you submit that to the Public Service Commission. So you really need both of those components. There's a lot of organizations right now that are actively intervening on behalf of residential ratepayers. A couple big ones in the state of Michigan specifically are the Citizens Utility Board, or CUB, and Michigan Environmental Council, MEC. So CUB and MEC are probably, if you're like, I don't want to do this myself, but I want to support organizations that are intervening, those two organizations are great. There's a number of others. I don't want to downplay that there's others, but that's really like the ground source of residential intervention. From an industrial standpoint, there's a organization called ABATE, and that is member driven. So big industrial manufacturing companies here in the state of Michigan who spend on the order of magnitude of millions to hundreds of millions on energy all come together, and then ABATE will come and intervene on behalf of industrial ratepayers. Like Erik said, that pie gets divvied up. Sometimes all those organizations work together to disallow as much as possible. Other times, those interveners are actually in tension, saying, you're pushing too much cost onto residential ratepayers or onto industrial ratepayers. Erik, what else is there to add to that?
Yeah, some interveners, like the Attorney General, uh, they have standing by right to intervene in a rate case. If you're being harmed, if there's a legal definition of standing for the PSC. So if you meet that legal threshold, you're allowed. But there's also you're allowed to intervene at the discretion of the PSC. So even if you don't meet the discretion by right criteria, the PSC can choose to allow you and say, like, yeah, you have a meaningful information that could be beneficial to the proceedings, or you're likely to be called as a witness later on. So we might as well get you in now rather than later, and then it'll speed things up. There's a tension between the number of interveners that are presenting information and the speed at which these proceedings want to happen. So more interveners are going to slow things down, but they also provide valuable information. There's a requirement that the rate case has to be determined within 10 months of filing. So the PSC is kind of in a race to get to review all this information, and it is thousands and thousands of pages. The utility will submit documents, in excess of 2,000 pages with tables and charts and everything. Then you have all the interveners are submitting their models and reports. So there really is a lot to go through, a lot of technical information to digest in a short amount of time. So yeah, it's a tough job that the regulators have.
So far, I think we've grounded the conversation in investor-owned utilities, and I'm going to kind of combine two or three questions here. One is thinking about investor-owned utilities and their market cap versus other companies in say, the auto industry, et cetera. Is the margin that they would expect appropriate for a company of that size? And is the return on investments that they get to, like, is that fair and equitable?
I can take a first crack, Erik. So I
Yeah.
want to answer that a little differently, and that is when I look at we look at energy for our clients in all different states, and we've had a couple clients who have like 5,000-6,000 locations across the country, and they've provided me all their data. And then when I dig in, there's one trend that I see almost universally, Dan, and that is in a given state, the lowest cost per kilowatt hour electricity is generally provided by a nonprofit. So either a municipal electric provider or a co-op. And this is the part people probably don't want to hear, some of the most expensive electricity provided in a state is often a co-op or a municipal as well. And the IOUs are kind of stuck in the middle. And so what I would argue is IOUs have scale and they are very professionally managed. Again, these CEOs are wildly impressive. So there's only so many mistakes they can make. When you talk about a public utility like a municipal or a co-op, when they are well run, their prices are unbeatable. Again, in Michigan, I think of like Holland and Zeeland have some of the lowest electricity prices. They are significantly less than consumers in DTE. They are very well run. They don't pay any taxes because they're a nonprofit, and they don't have any dividends that they need to pay. And so that's what drives it. However, if you just go up the lakeshore a little bit, and this is changing, but Grand Haven 5 and 10 years ago had electricity rates higher than consumers in DTE. But their problem is they kept sinking money into a coal-fired power plant that costs a lot to permit, spewed a lot of pollution, and just wasn't very cost effective. And so there's a nuance here, which is if you can figure out how to get a utility that's public and run it well, it will offer the best service and cost effectiveness. But there is the variability of if it's poorly run, it can be really bad. And so my short answer is like I don't really have a big opinion. Erik may have a better opinion on like is what consumers in DTE makes fair or reasonable. I don't know. I think if you made me Supreme Leader of Energy of America, we have 6,000 electric utilities. The country of Mexico has one. Clearly 6,000 isn't great. I think one maybe isn't great either, but I would probably have like a state-run electric utility because that's frankly how every state has to look at electricity right now anyway. It's economic development. You are not going to grow your state if your electricity prices are significantly higher than your neighbors from an industrial manufacturing standpoint or any other energy intensity standpoint. And so all these governors know this, and they're frankly already aligned. So I think if you just cut out the middleman and made the state in charge, they would have to figure out how to make their electricity more competitive than their neighbors. And that's kind of how you see it with other things. So sorry, that was a long-winded answer, but I think the current model isn't great. It is what we're stuck with. And yeah, Erik, I don't know what you have to add to that.
I think comparing them to GM and other industrial stocks and firms, typically these were considered the phrases like widow and orphan types of stocks where they're like you're not going to make a lot, but if you're looking just for a consistent return on your investment, like that's a very safe type of investment, these investor-owned utilities. So yeah, may not be as profitable as GM in the short term where they might be making a lot, but you're also not going to lose your shirt on an electric utility because at the end of the day, the Public Service Commission is going to make sure that the electricity is flowing and all of that stuff. So I guess that's it.
Thank you, Erik. And we have a number of questions about virtual power plants, and I think we'll be in touch about probably just scheduling a follow-up session on that, unpack a little further. And I think further we'll mark down the questions we didn't get to today and include what we can in some follow-up information. Erik, Mike, thank you so much for taking your time today. I always learn a great deal whenever I chat with you. And thank you everyone for joining us on our webinar, either live or via recording if you're catching this a little bit later in the week or month. And thank you again and have a wonderful rest of your day.
Thanks,
Dan.
Dan.
Take care.
Thanks, everyone.